All right, here we are. All right, we're live right now on YouTube. So welcome to Your Home, Your Move. What's happening in the Los Angeles real estate market? My name is Luis Sanchez. I'm a real estate broker, and you are?
Alex Islas, and I am a mortgage broker.
Okay. So there's a lot of uncertainty in the economy, a lot of uncertainty in the real estate market. There's a lot of perceptions that are going on. So we're going to give some actual data and facts to help you understand what's going on in the market today and give you some tips and insights as to how to move forward. So our agenda is one, implications for the of a recession. Number two, how the market is shifting. Number three, multi-generational home ownership. And then there's a recent Realtor.com article on the home equity tax. So we'll get right into it. In this session, it's live on YouTube. So I am inviting people to go ahead and comment. I'm inviting comments here. I'm going to ask some questions for the audience, and I want you to comment whether you're live on YouTube, whether you watch it later on other social media, on Facebook or TikTok or LinkedIn. I want to invite you to comment. We want to hear from you what your thoughts are and so forth. So we'll present the insights, and then we want to hear from you as well. So Zam says we're ready. Jay says good job with the podcast. Keep up the good work. Okay, thank you for the feedback. All right, so implications for recession. So people, these ladies here are hoping, as I've talked to prospective people looking to do something, some people want there to be a recession. That's my understanding. They want there a recession because they think the prices of home, recession means a slowdown in economic activity, people being laid off and things, and they want people to, I guess, property values to go down because they feel in a recession, property values go down, they're going to get a good low price property. So I want to just go over what actually happens in a recession, and then we'll talk about it now. So what has happened when we're thinking about recession? What happened in past recessions? So in past recessions, the question shouldn't be there. Well, anyway, this is showing that the interest rates during the last, I guess, 6 recessions has gone down in each time. 4.25, 5, 2.25, 0.6, 0.63, 1, 1. So the interest rates have gone down in past recessions. That has what's actually happened. And so my invitation to you who are watching is if the rates fall again, if there was a recession, would that actually change your plans of wanting to buy or sell? I invite you to comment, whether it's live or later on, yes or no. Does the falling rates change your plans or alter your plans for buying and selling, and why? How does the falling rates change your plans? And then here's just a question to think about. When rates fall, what does that do to everybody's qualification level? Okay, so Zam says absolutely. PP Mercado, that's what I'm saying. A lot of people are not feeling good about their jobs, especially looking at the AI trends, how this is affecting the housing market. Okay, all right, good points. Thanks for the comments. I'm not going to read the other comments that are coming on. We'll read them, but we'll see how we can. Alex, do you see the comments or no?
I do. I can. Yes.
Okay. If you see something that comes up, then you just you want to respond to, just jump right in. So when the rates go down, what does that do to everybody's level of pre-qualification? If I'm qualified, let's just say for 500, and the rates drop 1 point, now I'm going to get qualified for more, right? I'm going to get qualified for more. So now let's look at what does that do to the prices of homes in a recession? Like, people want a recession because the prices are going to go down, but what has happened in the past? Prices came up on most of the 4 of the last 6 recessions, except for 1991 was kind of like down a small amount, but in 2008 went down significantly. And just if you looked at my channel in past videos, we've gone over that was a change in the lending standards, and the lending standards changed. So therefore, people were qualified or were able to purchase in 2007. Those same people were not qualified anymore because lending standards changed. So that dropped the number of people that actually buy a home. So that's why that was the housing crisis 2008, and that didn't happen the other 5 recessions. So my question, I guess, for Alex, from a lending point of view, what should people, how should buyers be thinking about the possibility of falling rates? What do you say to buyers who are thinking that there's going to be a recession and maybe those rates are going to fall?
Well, I think this chart here is a telltale sign of what happens when rates drop, right? Except for the 91 and 2008. 2008 is pretty easy to explain, right? I mean, the whole housing market crashed. Um, in 80 and 81, rates were in the mid-teens. I mean, 14, 15%. That was the rate. That's why on that previous chart, you saw that rates drop, 4 and 5%, but they were at 15 and 14%, right? And if you go more recently in 2020 and 2008, rates did drop some, but not tremendously. But what happened to prices? Prices went up, right? So what people seem to believe is that once rates go down, now I can afford more, either to jump into the market or to afford more, right? So instead of buying an $800,000 house, so now I can buy a $900,000 house, and it's going to be the same payment as an $800,000 house was. So that's what happens. So prices tend to go up when rates drop, even if the economy is not doing great. Because if you can lock in, like in 2020, if you could have locked in, 2.5% rate, why would you ever sell your home, right? Why would you ever want to refi that?
Yeah. That's right. There's a lot of questions coming in, and let's just do this. We'll respond to all the questions that come up on the social media at a later time. We do appreciate the questions, and we appreciate the live viewers, and great. So I can't go over all this, but in terms of where this is at, so the rates are nationwide. The rates are nationwide, and the home prices are nationwide. Okay, so in California, there's more of a movement of prices, as if you watch the previous videos, our market moves at a greater rate than other markets. Okay, all right. So once again, those of you who just came on, we want you to comment. If the rates fall again, does that change your plans? Yes or no, and why, or why not? Okay, that's the question for the audience. We want to invite you to comment. All right, we're taking a lot of time already. It's already 7 minutes. Let's go to the second topic that we're looking at, is the market shift. You've heard in the news, there's perceptions that it's a buyer's market. The market is shifting. Let's look at the actual data that shows what's actually going on in the market. The data is showing that we have more homes on the market that are active and available. In 2025, you can see the number of homes available is more like closer to before the pandemic. The number of homes available in the previous, this is for May, in May was low. Doesn't mean that there wasn't that many homes available. It means that they were selling quickly. Put a home on the market and it would sell quickly. There's very little inventory available because they were being bought up, not actually that they were put up for sale. So right now there's a lot of homes more on the market than previous years because they're not selling as quickly. It's taking a longer time to sell. So that's a big change in the market. That's a shift in comparison to previous years. You can see it right there. And besides the number of homes on the market, so that puts that puts sellers in competition kind of with each other. So it says their comment, do you think buyers finally have power? What's supposed to show there is that this is a chart showing the percentage of deals where the seller offers concessions to the buyers, where the seller offers money for closing costs, money to buy the rate down, money to cover different things for the buyer. And so you can see that from 2023, it looks like, to now, the numbers have increased in terms of the number of deals where the seller's giving concessions to the buyer. So I guess the question for the audience, if there's more properties on the market than before, where sellers are competing with each other, if there's more opportunities, or there have been more closed transactions where the sellers are gifting the buyers credits, do you think the buyers finally have more power in the market, or is it still tough out there to buy a property in Southern California? What do you think? Audience, we want to hear your comments on this. Now, just Alex, so what do you think? How can a prospective buyer take advantage of this situation with a lot of properties on the market and a lot of sellers offering concessions?
Well, I think one of the biggest newer type of concessions that buyers can get it's what's called a buy down, a rate buy down. So you can do it 2 years, 1 year. I think a couple lenders have 3 years. So that means like if you got a rate today at, let's say, 6.75%, and you had a 2-year rate buy down, that means that in your first year, your rate would be 4.75. In your second year, it would be 5.75. And then after the second year, it would go back to the original 6.75. But the advantage of that is, your payment is a lot lower for the first year to 2 years. And in that meantime, if rates drop, you can always refinance.
Mm-hmm.
So let's say rates do go from 7% or 6.75% to 5.75%. So you've already taken advantage for those first 12 months, getting that lower rate. Now you can refinance, not a cash out, just refinance the same loan for the same amount you owe now for that lower rate.
I see. So a 2-1 buy down is an option where initially I'm hearing that the initial payment is lower for the first year by 2 points, and then lower by 1 point the second year. Then it goes back to the standard rate. Is that right?
Correct.
Okay. And then and then that costs money. So would you recommend maybe in this market the buyer asks the seller to cover that cost, or?
Oh, absolutely. I mean, especially if they're giving a concession, you're better off. I don't have the chart, but you're much better off getting the lower rate for the first, couple of years. And let's say, instead of buying the home for 800,000, you buy it for 790. You're much better off getting that $10,000 concession going towards your rate. You're going to save more money over the long run, getting that rate buy down versus getting, buying the home at a lower price.
I see. Okay. And then if you're just from the perspective of a seller, if you're a seller here, and we have this situation where a lot of people are giving these credits, right? You don't want to be giving away so much money. So I guess my recommendation to you is to do a pre-sale home inspection of the property, find out what's going on with the property, the age and the condition, and things that need to be switched out, or things that you didn't know about need to be repaired. Get some of those things repaired so that you're selling a property that is kind of like as move-in ready as possible. So you're not going to be getting, buyers requesting money for repairs. And then that would help out a lot. And then we can help you with that. If we can give you the free inspection. We can get some of the repairs done for you, and just get credited later on through closing. Okay, great. The third topic. Anything else you want to say, Alex, on the topic of concessions?
No, I think we covered pretty much what we needed to cover. I would definitely ask for a rate buy down.
Rate buy down. Okay, good.
Yeah.
Good. And then, so now with affordability being pretty low in California, prices of homes are high. It takes a huge income to qualify. So a lot of people are doing multi-generational home buying, right? So multi-generational is that picture there. You have a couple generations buying together, mom and daughter buying the home together and living together and qualifying together. So we could see that the number of multi-generational homes actually went down. When the rates came down, people were buying more on their own. But now as the rates came up, there's more people who are buying together, more families that are qualifying together. 17% of the closed escrows last year were multi-generational homes. And Rick Sharga says that from the CJ Patrick Company, says there are a few ways to improve affordability, at least marginally. Purchase a property with a family member. There are a growing number of family multi-generational households today, and affordability is one of the main reasons for this. Veterans United conducted a survey of prospective buyers this year. 3 out of 10 home buyers say they're planning to purchase a multi-generational home. In that same survey, they say multi-generational homes are more than a trend. They're a meaningful solution for families looking to care for one another, care for older people, right, while making the most of their home buying power. Also, obviously, caring for the kids, the grandkids can help take care of the grandparents, take care of the grandkids, or if your parents are older, the children taking care of their elderly parents is possible here. Now, how is this? I guess the comment for the audience: would you ever consider buying a home with your parents or adult children That way you could afford more space or a better location or a closer in location to the city and not so far away. Yes, maybe never. Would you buy with your parents or adult children, and why? I'd like to hear your comments on that. And then the question for Alex, what are the factors that go into people buying a home with a family member? How does that work in terms of qualifying for a mortgage?
So the way it works is mortgages are based off of a couple of things, but the largest factor is your debt to income ratio, meaning how much money do you make, and then what you can afford, right? So if you make, let's just for the sake of using round numbers, if you make $10,000 a month in income before taxes, this is before any deductions, right? Before any taxes are taken out, or any kind of like 401k deductions or whatever is deducted from your paycheck. Before that's deducted, we take 50% of that, of the gross. And that's what we use for your maximum debt payments per month. That includes your mortgage on the home, taxes on the home, insurance on the home, plus any other debts you have, like a car, like um, credit card payments, a personal loan, whatever. So that all gets bundled together, and that's your part of your debt to income ratio. So if you make 5,000 and you have 1,500 in car payment and other debt payments, well, you only have $3,500 left out of your income to be able to afford a home, which includes your mortgage, your taxes, and your insurance. Now, if you have multiple people on the loan, now we can use everybody's income. But then we have to use everybody's debts. So you have to be kind of careful and make sure whoever goes on the loan with you doesn't have a lot of credit card debt or has, high car payments where, let's say they're making $5,000 a month and we can use 2,500, but yet their debt payments are $3,000 a month. Well, that's not going to work, right? But if they're making 5,000 a month and they have no debt, then we use 2,500 of that to qualify for the loan.
Okay, I see. So you can use their incomes to qualify for a higher amount, get a larger property further away and more convenient location. I guess the question you mentioned about the debt and your family members having debt, what kind of conversations, before we're going to jump in this venture together, what conversation should we have before we go into buying a home together? What if I'm going to buy a home with my sister or with my mother or my brother? What should we discuss amongst each other before we do this?
I mean, I just keep it real simple. Just find out, be honest with each other. Say, okay, how much money do you make a month before taxes, before paying health insurance or whatever comes out of your paycheck? What's your gross pay per month? And then, go on freecreditreport.com or that's through Experian or Credit Karma, and look at what the minimum payments are for debt. So we don't care, you could owe, and I'm going to be very facetious, but you could owe $1 million in debt, but your payment's only $100 a month on that million. We only care about the $100 a month debt payment, not the total debt. So, but if you owe $10,000 and your debt and your monthly payment's $1,000, well, we care about that $1,000. Okay. So I would sit down with my, whoever it is, and say, okay, what do we make? And then what are our minimum monthly payments for debt?
I see.
That's where you can kind of figure out, is this going to work? Like I said before, if they're making $5,000 a month, but their debt payments are $3,000, they're not going to be very helpful.
I see.
In fact, it could hurt you.
I see. So it sounds like you said that they should be honest with each other about their income, have a conversation about how much money do you guys actually make, and then what are your actual debts. And then you said go on to look and see the credit report and see what's on the credit report and what their payments are and what they owe, because that could affect your qualification.
Right.
Now,
and also,
if they have trouble, like not everyone understands how to read a credit report, can they, talk with you or reach out with you? And if they have questions?
Absolutely. Yeah, absolutely. Anytime. Please reach out anytime. I'm more than happy to help. No obligation. There's no cost, obviously, for something like that. And another thing that's to look out also is make sure that credit's not too low, because what we do is is when you buy a home, we don't just take one credit score, right? We take Experian, Equifax, and TransUnion. And what happens is you take the highest score and the lowest score, you throw them out, and then we use what's called the mid score, the one that's left over. So you could have a credit score of 750 on, let's say, TransUnion, and 730 on Equifax, and 700 on Experian. Well, we're going to use that 730 because that's the one in the middle. Mm-hmm. So, but if you have multiple people on the loan, let's say you have 2 or 3 people. I've done this. I mean, I have clients that, we had husband, wife, brother of the husband, daughter of the husband and wife. We're all on the loan to qualify for the loan. And so what we did was in that case, we take the lowest of the mid scores. So if someone has a 560 score, that's one of the borrowers, well, you're going to be in trouble because that's the credit score we're going to have to use, even though, let's say, another borrower had a credit score of 750. So those are pitfalls you have to look out for.
I see. Okay, so they can get with you on that, right? They can reach out with questions about okay.
Absolutely.
Wonderful. So the next topic is a recent article that came out in Realtor.com about the hidden home equity tax, and this affects a lot of people in California. I want to go over this briefly, but here is the article. You can see the map. It affects 62.2% of homeowners in California. They have this home equity tax that not everyone knows about. There are benefits of owning homeownership. The federal government has encouraged homeownership, and so we'll briefly go over some of the main points of the article and try to give you some understanding with this, and then get some insights. So the federal government gives or actually charges if you buy a property and then sell it, you made a profit, so you have to pay taxes. People don't know this. You have to pay 15% to the federal government, and then it's about 9.3% to California, depending on your income. Most incomes in California, the tax is 9.3%. If you make over $330,000 a year, then the tax is higher. But the federal government gives you a tax exclusion. That's one of the federal government's way of encouraging home ownership. The federal government wants people to own homes. People own their homes. They have more vested interest in their community, stronger community. That's the theory behind it. So you could have $250,000 of profit and pay no taxes if you're an individual. If you're a married couple, you could have $500,000 of profit and pay no taxes. However, people in California, 62% of us, as the map shows, homeowners, have more equity than the capital gains tax limit and therefore have this tax burden when you sell. So, for example, here's a scenario. Let's say someone bought a home in 1985 for $100,000. I'm just giving you an example. It sells in 2025 for $1 million. Let's just say they have write-offs, improvements that they made and costs that they've incurred of $200,000. So I'm not sure if you can see my cursor, but my cursor is showing they sell the property this year for $1 million. They have minus 200 in write-offs, minus 100 the purchase price they bought it for. They have a taxable gain of 700,000. That's a capital gain they're supposed to be paying taxes on. If they're an investor, they're going to have to pay 15% of 700,000 or 105,000, and 9.3% of 65,000, which is 65,000. So they're going to have to pay taxes of 170,000. Right? That's a lot of money that maybe if you didn't know that you have to pay taxes on if you don't buy another property that's more expensive, 1031 exchange. If it's the home where you live in, you made 700,000 the taxable, but you're married, so you minus 500,000, so your gain is 200,000 that you have to pay taxes on. So you're gonna have to pay 15%, and 9.3% comes out to 48,000. That's a lot of money. 48,000 is a lot of money that maybe someone didn't expect they're going to have to pay in taxes because their property value went so high. So basic information from the article, that exclusion of $250,000, $500,000 for a married couple was put into place in 1997. Since then, property values have increased by 260%. So if that's the case, if they were going to adjust the taxable what you're not taxed on, then it should be $660,000 for individuals and 1.32 for couples, married couples today. And according to this article, this hidden tax discourages homeowners, especially older adults, from downsizing or relocating because they want to pay the same large tax. Larger homes that are going to sell for more or appreciate more stay off the market. They don't downsize into smaller homes. And so that makes sense. There's less people trying to sell into a smaller home. That less people selling makes prices go up for everybody. So here's my question I want the audience to share. If this tax issue was to hit you today, if you want to sell your property and then you have to pay this capital gains tax because you bought in California and California increases a lot, does that affect your decision to sell or move? Does paying an extra tax like this affect you of buying or selling, and why? And why? We want to know what your thoughts are on this. And so, my question for Alex, actually, people don't want to pay this tax. Maybe they have a low interest rate. So, what options do they have for refinancing so they could just keep the property but get the equity? How does that work?
Well, a couple of things you can do. You can either get now a second lien loan, so a second mortgage, so you don't lose your first mortgage. The rate on your first mortgage, I've done quite a bit of those lately, where let's say someone locked in 2020 and they have a rate of 3 or 3.5%, and if we were to refi the whole loan, now they're looking at 7.75 or 8%, right? Because when you refi and you cash out, that rate's always a lot higher than if you were buying. So just remember that. So you don't want to refi the whole amount. You only want to refi, do a cash out on what you would need. Let's say you needed, you bought that, and like in your scenario, the home is worth $1 million. They probably paid it off a long time ago. Now they have $1 million in equity. They don't want to sell the home, or even if they had a loan for $500,000, let's say, and they could take out another $200,000 to buy another home or help out a family member buy a home. Then we get a second lien mortgage. So yes, the rate's a little bit higher, but you're only paying that higher rate on a small amount. So in this case, you would only pay the rate on $200,000 versus $700,000. You can do that, or you can get a home equity line of credit as well. HELOCs are different. I'm sure everybody's heard that acronym HELOC. And HELOC, it's not like a credit card anymore. It used to be where the bank or a lender would say, okay, you have a $150,000 or $200,000 line of credit, and you take it out whenever you wanted. Now the way they work is you have to take out most of the money in the HELOC immediately. So even if you didn't need the money, you're forced to take it out and keep it for a few months, so you're paying interest on it. So those are things that you have to weigh when you're getting this kind of loan. So those are things we discuss, and I discuss with my clients is, okay, let's sit down and write down really what you need, what your goals are, how we get to your goal, and then put a plan together for that. That makes most economic sense for you.
I see. So what a homeowner could do, you're saying, is keep their low interest first loan, and then get a second loan or get a home equity line of credit.
Correct.
Based on the equity that they have, so they keep their low interest, and then they just get maybe higher interest on the second, so they can have that money to move on to the next property and keep this one.
Right. And if they have, I just did a loan this week, actually, for a client who their home is worth, I don't know, $2 million, right? They've lived in it for 50 years. They bought it for nearly nothing 50 years ago. Now it's worth a lot. But they're equity rich. They don't have a lot of cash. It's all in the home. So they wanted to help out one of their children buy their home. So we took out a $500,000 loan against the primary residence, and that was a first lien loan. So those rates are lower. Just in this case, because the loan to value was so low, it was 25%. We got a rate at 6.5%, which is great for a cash out refi, because usually cash out refis are in the mid 7s or higher.
I see. Okay. All right. So thank you, Alex, for that insight. And this is you can, the conclusion of our video. You're welcome to follow on social media. We'll put the links. There's PDFs of real estate services and property management We've got YouTube playlists specifically for buyers, sellers, compradores, vendedores. You can email or book a call with the link. I wanted to ask Alex, for someone's on the fence, they're not sure if it's the right time to buy or sell. What's your message for those people who, I don't know if I should buy or sell? There's a lot of properties on the market. Are the prices going to go down? Are the rates going to go down? What's your message to those people?
Well, it's funny you mentioned that, because I actually had a call with a client this morning, and he put an offer on a home, didn't get it, and he was kind of like, oh, maybe it's not the right time for me. And then he called me this morning and said, you know what? It's never the right time. It's never the perfect time. You just have to do it and jump in. And it's true. I mean, I mentioned this before. My father-in-law bought his first home, 45 years ago, when you're showing those rates in the 80s and the rates were at 15%. He bought a home then, and he said, he's so glad he did, because people are telling him, oh, you're crazy. Why are you going to pay 15%? And, rates are so high. And I mean, imagine if he wouldn't have purchased that home such a long time ago, right? If he would have just said, no, rates are too high, right? You can always refinance your rate. You can never renegotiate the purchase price of your home, right? So people that bought 5-6 years ago, they've made money, right? Rates have gone up, but let's say you bought today, and 5 years from now, the rates are lower, but home prices are higher. So you can always refinance your interest rate, your mortgage, but you can never renegotiate the purchase price of your home.
Yeah, that's right, and that affects your taxes. If you buy at a higher price, your taxes are higher forever.
Property taxes are higher, insurance is higher, everything's higher.
Everything's higher, yeah. And the cost of material goes up as time goes on with inflation. Yeah,
well, especially now with the fires, here in Southern California and LA, it costs even more to do construction. Now with, less labor because of the immigration raids, it's going to cost even more now to fix up a home.
That's right. And so what is the first step? Someone's out there thinking about, hey, I want to jump in. I want to look at this. What's the first step?
Well, first step for at least on my side, I know this is important for you too, Luis, is have a conversation with me, and I'll gather your tax returns for the last 2 years, your W-2s, your last 30 days of pay stub if you're a W-2 employee. If you're self-employed, there are a lot of other ways we can get you a loan. It doesn't have to be, you don't have to use tax returns. We can do loans using bank statements. If you own a business and it's your business, or you own 51% or more, we can use your bank statements of the business to qualify for the loan. So a lot of different ways to qualify for a loan. Everybody thinks you go to the bank and you turn in your documents and that's it. Like, no, that's not the way it works.
Okay.
And if you go to like a Chase or B of A, you're kind of stuck in their box of the type of loan they can do for you. Working with a broker like me, I go out and I work with Rocket Mortgage. I work with a lot of different lenders out there that have a lot of different programs. And so, it's not a one size fits all. Everybody's different. Everybody's financial situation is different. So, we tailor everything to what you need.
Okay. Now, this consultation with you, this conversation, this looking at what the scenario is and my tax returns, how much does it cost me for you to consult me and guide me on this?
It doesn't cost you anything.
Free. Wow. Make sure you guys.
And for and most of the loans that I do doesn't cost you anything. So I don't charge. Obviously there are fees involved, right? You got to pay for appraisals and credit checks. And escrow and things like that. But as far as the loan, like paying me, most of the time my clients don't pay me anything.
Okay.
Directly.
No, my question was just for those who don't know out there, just having the consultation is free. Just to talk and gather information, look at the scenario, it's all free. So make sure you guys take advantage of the resources that are here, and also his knowledge and experience and willingness to look at your scenario to give you the best deal possible. Thank you. Thank you for watching. If you saw value in this, please like it, share, comment, subscribe, so that these channels that are being posted on is more discoverable and more people can use the resources that we're providing. So look forward to hearing from you on the comments. I hope that you commented. Some on the live stream did comment, and I'm going to read them. Looking forward on all the social media platforms, the people commenting, and we will definitely reply. So thanks, Alex, for being here, and we'll see you everyone on the next one.
Yeah, thank you, Luis. Thank you, everyone.
All right. All right.